so let's pick up where we left off. We were talking about common stockholders versus preferred stockholders. So common stockholders' rights. Common stock is the normal stock most companies have. It's your regular stock. Not every company would have preferred stock. But let's talk about the common stockholders' rights. The first thing they have is they have the right to vote. We talked about that in the hierarchy section. They have the right to vote on things like the board of directors, whether or not there should be a new stock issuance, things like that. So common shareholders have the right to vote. Board of directors, mergers, okay. Dividends. They have the right to dividends if they're declared. Now, not every company has to pay dividends. It's a choice whether or not they want to pay dividends. But if they declare them, I can't decide, I want to pay you, but not you. Everybody gets the same dividends, right? Depending on how many shares of stock you have. A share of liquidated assets. Let's say the business were to go under, right? The corporation were to dissolve, and if there were any assets left after everything was liquidated and all the liabilities were paid off, which is probably pretty unlikely, right? Because if you think about it, why would they have gone out of business if they had enough money to pay off all their liabilities? But the point is that if there are any assets after the business has been liquidated, right, and there you go, all the liabilities have been paid off, then the shareholders get whatever's left. They get their, piece of it. All right, and the last right that they have have other rights, but these are the main ones, is the preemptive right. Preemptive right means that if there is a new stock issuance, right, they decide they're going to sell more shares of common stock, they have the right to retain their ownership percentage. Think about it. This is a rather extreme example, but let's say that you own a corporation, you own 51% of the corporation, and you're going to issue more stock out there to the world, and you want to retain that 51%. You have the right first to buy enough shares of stock of the new issuance that you maintain that 51% level. Okay, so you have the right to basically buy stock first in order to maintain your ownership percentage. Preferred stockholders. Like I said, not all corporations have this. Preferred stockholders' rights can almost have any rights that you want to give them specifically. They usually do get their dividends before common shareholders. Okay, so if the business declares dividends, the corporation declares them, then the preferred shareholders get their dividends first, and common shareholders get the remainder. And you'll see that with numeric examples in a little bit. They get liquidated assets before common shareholders. So back to this example, the idea being that after you pay off all your liabilities, if there's anything left, it goes first to the preferred shareholders to reimburse them, and then it goes to common shareholders. Here's one of the biggest pieces. They don't vote. Okay, so really people looking to buy preferred stock are primarily buying it as an investment. They're not interested in running the business. A lot of times what preferred shares have built into them is a dividend, and you'll again see that in a little bit. But they have kind of a guaranteed dividend amount built into them. Not that the company has to pay a dividend, but if they do, preferred shareholders get their dividends first. So like I said, it's kind of an investment more to buy a preferred stock. It's not looked at like common stock where it's an investment, sure, but common shareholders have the right to vote, so they have a little bit of a say in the running of the business to some degree. All right, let's talk about stock terminology. The first thing I want to talk about is authorized stock. So that is the maximum amount of stock to sell. It's stated in the charter, and it is the full amount, right, set by the board of directors. So when they're putting together the charter, whenever they're saying maybe we have 1 million shares of authorized stock, a lot. All right, but they're not going to sell all the 1 million shares the day they go, the day they become public. What they're going to do is they're going to issue some of that stock. So let's say we have 1 million shares authorized. Picture them all in a big giant vault. And then they sell some. The ones that they sell that go out into the world are called the stock that has been issued. Okay, the shares that have actually been sold. Now let's say I sell 50,000 shares, right, of my million. So I have 50,000 shares of issued stock out there in the world. And it's also considered outstanding stock. So that 50,000 shares was both issued because I sold it, and it's outstanding because it's out there in the world. Now what if 50,000 shares of stock out there in the world, I decided I didn't really want that many shares of stock out there. I'm going to buy some back for myself. Maybe I'll buy back 10,000 shares. All right. So if I were to repurchase my own stock in the market, it's called treasury stock. All right. When a corporation goes and buys its stock back, that's called treasury stock. So really at this point, 50,000 shares were issued. If you're following along with the numbers I was just using, 50,000 shares were issued. They're out there in the world. But now, if I repurchase 10,000 of those shares, only 40,000 are outstanding still in the world. Okay, I hope you got that. If you didn't, rewind me, listen to it again. The idea is issued is, has it been sold ever? And if it has, then it's issued. But outstanding are the ones that are still out there in the world in other people's hands. Okay? So treasury stock is really the ones that are issued, right? Well, the way you can think about it is the ones that are issued, right? The 50,000 that were out there, minus the ones I bought back for myself, 10,000 shares, give me the outstanding shares of stock, 40,000. All right? So just so you're going through these and you understand the terminology in the chapter. Let's go look at a couple of journal entries. We haven't done those in a while. All right, assume Dixie Corporation issued 1,000 shares of $1 par value common stock for $50 per share. Let's talk about par value very briefly. Par value is an antiquated concept. We still use it, but it's an antiquated concept. The idea being a share of stock is at least worth $1. I don't know why. I mean, I do have an idea, I do know why, but it's not worth going into the explanation. The idea in general is just, it is an outdated concept, but we still use it for our journal entries. All right, so let's go into the example here. I mean, feel free, Google what is par value, and what they're going to say is it's an out-of-date concept that we still use. All right, so the thing is we are going to issue 1,000 shares of $1 par value common stock, but we're going to sell it for $50 a share. So what we do is we record, there we go, we record the cash we received because we sold 1,000 at $50 each. That's $50,000. So we debit our cash for $50,000. We then credit our common stock for the par value. We always record the stock at par value if there is par value. 1,000 shares at $1 a share. That's $1,000. Anything above that amount that you're selling it for above par value. So you look, we sold it for $50 a share. So we really sold it for $49 above par value. That is actually called paid in capital in excess of par. Right? It's a lot of words, but think about it. It's capital that's being paid into the business above the par value, excess of par. Okay, so now how do we treat that? The way that we treat that, where it shows up on our balance sheet, is actually right here, paid in capital in excess of par. All right, so it is an additional category in that paid in capital. Okay, let me go back. All right, so if there's par value, you have to record the common stock at par value. It's just the way it is. Now, you don't just have to issue for cash. You can turn around and issue for land. You can buy things with stock. Like, let's say you didn't have the cash to buy a piece of land, which is what's going to happen in this example, this next one. You can say, hey, I don't have the money to buy your land, but how about, would you like some stock? So if that's the case, you would record the common stock still at par value, and anything above that would be paid in capital in excess of par. So let's look at the numbers. You issued 1,000 shares of $2 par value, preferred stock this time, but you treat them the same way, in exchange for land with a fair market value of $100,000. So we're going to record the land at $100,000 because that's what it's worth. We're going to record the preferred stock at par value, right? $2,000, $2 times 1,000 shares, and anything beyond that, paid in capital in excess of par, $98,000. Okay. Third example. Let's say there's no par because the company decided it was dumb and we're not going to follow par value anymore. All right, so a lot of newer companies, more modern companies have gone with no par common stock. So if there is no par, assume Belson Corporation issued 100 shares of no par common stock for $50 a share. Guess what? We just record debit to cash, right? 5,000 because it's 100 times $50, and a credit to common stock. That's it. No paid in capital excess of par, none of that. Easier, right? Okay, let's talk about preferred stock a little bit. I want you to realize that preferred stock often has dividends built into it. Okay, that's why people buy preferred stock, because they want/expect those dividends. Dividends can be listed two different ways. You might see it written two different ways. They might just tell you this is the amount of dividends. So this first one, $4 preferred stock, they're just telling you the dividend's $4. If you own a share of preferred stock, we're going to send you $4 a year. That's it. They're just telling you. Or the other way you will see it written is you will see it as a percentage. So they're saying the stock is $100 par value, okay, $100 par value on that stock, and it's 4%. So really what they're saying there is they're saying it's 4% of the par value, which is $4. So these two different ways are exactly the same, mean the same thing. It's a $4 dividend. All right, so you're buying with this stock with the expectation that you're going to be paid $4 per year for every share of stock that you have, preferred stock. All right, so we're going to get into some numbers in a minute.